Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am going to talk to Sonya Rocvil today, and I hope I did not butcher her name. She's the principal and founder of Bedrock Real Estate Investors, a privately owned real estate company specializing in the acquisitions and asset management of multifamily apartments all over US. Interesting, she began her career as an auditor and later transitioned to finance at a Fortune 500 company. So I'm also going to talk to her about auditing. And she is still a CPA as well as a licensed real estate agent in the state of New York. So welcome, Sonya.
Thank you so much, Alpesh, for having me on.
Absolutely. So first question we ask everyone. Tell us something interesting or funny about yourself.
Okay, so I used to have a job as a security guard.
Oh, wow. That's a story. Wow.
I'll elaborate on that because it's a little bit. So it was actually campus security when I went to undergrad. Perfect. And I was one of the people who was just signing in folks who were, coming to visit the dorms. So it wasn't, I wasn't like a full body armed security guard or something like that. But it was a really interesting job. One of my friends was one of the people who was overseeing that type of position. And it was actually pretty funny to see how what they would do just to not sign in. I didn't understand.
So I think it makes sense, right? Security guard to auditor.
I think so. Yeah, you're right.
So this is very interesting, but because you are an auditor, CPA, how did you get started with real estate and why?
Yes. Yeah. So, I always had this fascination with real estate. We grew up, my family and I were from Queens, and we would every holiday we would go and visit my father's family who lived in Brooklyn. And at that time, it was a little bit back in the day. Brooklyn isn't what it was, right, what it is now. And so I'd see a lot of abandoned homes and dilapidated places, and it was almost like, we have people who need to live in homes. Like, what's happened to these homes? And so that it was something that kind of stayed with me. But when I decided on my career path in accounting, I got some mentorship advice from someone in my church, and he was just like, accounting is the basis of everything. It's the language of numbers, and so just study that, and then it'll take you wherever you want to go. And so that's what I did, and I started out in audit. Spent a few years and realized after I got my license that I really didn't want to become an audit partner. So I knew at some point I'd have to leave. And so I moved on to American Express, and I had a great career there, number of years. And I spent the majority of my career there. But as there are always changes in the business, my group and my team, we were all displaced. We all got let go and we were laid off. And so, during that time, it really gave me some reflection points, because I reflected on the fact that there's real estate really all around us. Everything is real estate, our homes, where we go to work, where we go to shop, everything is real estate. And so it really it gave me a chance to take a step back, or as opposed to going to work for another competitor or, going somewhere else in financial services. I had an opportunity to take a step back. And unfortunately, I had support from my family and my husband, and I joined a bunch of real estate organizations. I joined our local RIA here in New York. And from there, I found out about a real estate investing group that was focused on multifamily. And that really resonated with me, because we grew up partially in an apartment building before we moved to our house. And I just kind of got it, like apartment buildings and just the community that they can provide. And that just really set me on the trajectory, and joining those groups was really helpful. I met joint venture partners there, and then I ultimately moved forward with it.
So what was your very first real estate investment?
My very first real estate investment was actually when I joined the multifamily group. I invested in an apartment complex that was in Florida. It was in, I believe it was in Jacksonville in Florida. And it was one of the first deals that I had invested in. It was over 100 units, and it was a value add deal. One of the things that was a takeaway from that, though, was there was a hurricane that happened, and I think we were all bracing ourselves as to what was going to happen to the property. Fortunately, it ended up being fine, but it was a great opportunity to just passively invest first. That was one of the things I thought was really important to my story, as I was talking to investors, having invested in other deals.
Oh, that's great. Yeah. So you started directly, like not like us or most of the investors, where we start with single family, we learn the ropes, slowly we move forward, and then we end up with multifamily. And then, right now, of course, I focus more on mobile home parks and senior housing. But so you directly invested passively in a multifamily. So what kind of
Yes.
assets do you own right now?
Yeah. So it's right now it's multifamily. So that's the core asset that we have right now, and that's our focus. I really like multifamily a lot. I feel at the end of the day, everyone needs a place to live, and I'm sure you see the same thing with mobile parks as well, and senior homes, like providing that shelter. It's a basic need,
Yep.
and so that's something that, again, just really resonated with me, and it's been an asset class that I really enjoy.
Oh, that's great. So we want to talk about underwriting and due diligence. Can you explain the difference between those two?
Yes. Yeah. So I'll start first with underwriting. So underwriting is really the process of putting together your analysis of how together projections on the revenue growth, the expenses that you think is going to happen for the property over the time period that you're going to hold that investment. Due diligence actually really starts even as soon as you pick a market, as soon as you decide that you want to move into whatever asset class it is. And for me, I invest out of state. I'm in New York, but invest in the Southeast. And so my due diligence really started when I decided, okay, I'm going to pick this market to invest in. And our first market was Atlanta. And so it was understanding the market, understanding the trends, what's happening with jobs, what's happening with the local government, understanding that macro, getting a view of the state and the city, and then going even further when you start looking at properties. What type of property are you interested in? Are you looking at, what areas are you interested in, and that's market. So you're looking at your market and then your submarket. So your process really starts there, because you're gaining a background and understanding of properties and the areas that you're in, which is critical for when you're having discussions with investors. For us, we do deal syndication. And so that's really important that our investors feel that we have a good understanding of the area. But then to take it a step further, that's just where it starts. Once you find your property, you're doing, or even before you buy it, you're doing a lot of due diligence on the area itself, that like micro market, where your property is located. What is the retail like in that area? Who are the people that want to live in your building? Having a good sense of that demographic. And then ultimately, when you're in contract and you're looking to purchase the property, you're doing work to verify the items and the numbers that you came up with in your underwriting. So you're doing a deep dive into understanding the revenues, what they are, whether you feel that they can be increased, what will cause that increase, how much capex do you need to have upfront or reserves to execute on those upgrades, what is happening to the expense line items, your taxes, your insurance. All of those pieces are so important because they're going to affect how your property, the measurement of how your property is going to perform.
Got it. So that's so what is your actual underwriting process? Do you have like steps identified?
Yes. So one of the things that we do is, first is taking a look at revenue, understanding where your rents are right now. And usually in year one, we don't get super aggressive about how rents will increase in year one, unless you're in a market or, it's already proven that you have for that property substantial differences between in place, some of your current residents and between your residents, meaning that you have residents that are paying substantially different amounts that are currently living there. So, but what we'll do is we're planning for most instances when there's value add, that over the end of that year towards the middle of that year, second year, that we're really going to be pushing to do the value add and enable that value add strategy. So we really have to map that out for our process. And that means doing a rent analysis and looking at all the units. What happens if you get your projected rent over what period of time? What does that average rent really turn out to be? So, doing a really detailed analysis on that. And then the underwriting for our expenses, we all know that inflation is a very big thing right now. So, you really have to take a look at how much things are really going to cost. Or your rolling 12 may not fully reflect what's going to be happening most recently. So you may want to understand more recently your past 3 months of expenses and look at that.
And supply chain disruption.
Exactly,
right?
Exactly. That is such a challenge right now to forecast. But another big piece is, your real estate taxes as well. Just understanding what those are going to be. I know my very first deals that I underwrote, I put in and I thought I didn't change the taxes and thought, oh, great, this deal is going to work.
Happened
and
with
then
me as well.
another view of it, and I was like, oh no, this deal doesn't work at all because taxes are so much more. So making sure when the taxes are going to be assessed and having that in the right year, but also making sure you have some numbers in there.
Oh, that makes sense. So can we talk about the due diligence process or some of the documents or you look at during due diligence?
Yes. So on the revenue side, one of the things you're going to be looking at are the leases. So you want to make sure that the amounts that are represented in the rent roll are actually reflected on the lease. If sometimes it could be that there may be discounts reflected on the rent roll that are actually in the lease that you need to take into consideration, because that's going to affect your cash for that apartment or for that unit. Understanding
and sorry to interrupt, but that's one of the very important thing. We just had recent example, and that's why I wanted to share. We acquired a mobile home park back in August, and we had to delay the closing by a month because we found out that there were some issues with the rent roll. So it seemed that the seller was putting money in on behalf of tenants for last 3 months because he wanted to sell the property, right? And then during due diligence, when we were actually watching, right, because we were asking for the documents constantly, it's like, oh yeah, they haven't paid. So we dug deep and we found out that for last 3 months, there were like literally no tenants on about 9 homes. And so we went back and we of course liked the deal. And actually, knock on wood, the mobile home park is doing great right now. But we renegotiated the price as well. We, I think, got about 80 grand worth of discount, which was worth it. But
that is a great takeaway. That's really important. And that's why you really do have to look at what's happening. What have people signed up for? Sometimes they're expired leases. And, they just have people there that they just didn't do anything. And, you don't know what's going to happen. So you have to take that into consideration also.
Yes.
Yeah. And so then and then you're also going to just understand your other income line items as well. Some of the things that we look for are the late fees. So yes, that's a component of other income. but it's sort of like it's not the best income,
Right, and it's
because
not the
it's
main
a
income. You
it's
actually don't want late fees. You don't
correct.
want to enforce that. That's how it should be, right?
Correct. So if you're seeing, large percentage of late fees, that's also giving you an indication of what's happening on that property.
Right.
And then as an operator, you have to determine, okay, is this an operator? Is it the resident base that's in that area? How is this going to be different? Because you really don't want those fees. You want to have, it's like a quality of earnings type of thing. It's not the best quality of earnings. And then moving into your expenses, top of the list, as I've said before, is your real estate taxes. So you're going to do a cursory review, but you do want to have a conversation with somebody in the county, making sure that you're calculating that appropriately, so you have the right amounts there. Insurance is a big one as well. You're wanting to get insurance quotes. You want to understand loss runs and whether or not there's been any issues on the property that's going to impact the quotes that you're going to get. Ultimately, your bank or lender is going to also have some say as to what type of coverage you're going to have, but you can also get preliminary view just based on what's happening already on the property. For your utilities, you're going to ask for at least 12 months worth of utility bills.
Right.
In some cases, if you can, 24, to just make sure you understand what's happening, the trends. You're looking at the bills, making sure it's the same property, it's not some other property that you're getting, making sure you understand, any just the trends and ups and downs, and that you have a solid number in your financials that you have. And then also it's going to be an understanding of your strategy for that property. Are you doing a heavy value add? Is it light renovations, and trying to get quotes so you can see what how you'll be able to execute your plan, and the cost to do some of those updates and upgrades, so you can feel that you have a good CapEx budget for that.
No, those are some of the really, really important points, and I couldn't agree more. So one question I have, because you covered this really well, underwriting and due diligence. How were you able to transition your auditing background into underwriting and due diligence?
It's so funny that really felt that in my transition over to multifamily, I did lean pretty heavily on my background in both the accounting and just understanding financial statements,
Right.
and that audit background, because that's part of the work that you do as an auditor. You're verifying the numbers in the financial statements, and that's usually from some third-party document like a utility bill or some or invoices, so things like that. And so it was a direct parallel actually to that skill set. And that's you're trying to find out, like, am I missing anything? That's the big thing. You want to make sure that you're not missing anything significant in your underwriting.
Oh, that's great. And how is having a CPA license as well as real estate license helping you with multifamily acquisitions or management?
Yeah. I mean, so I was having my license. I mean, I focus on audit and not tax. So very often people think, oh, you're
okay.
a CPA, then maybe you do the taxes for the property. I do not.
No, of course not. And you should not.
No, absolutely not. I think just coming from my profession, I know that there's so many nuances that you really want to have your strongest tax professional looking at your reports, making sure that they're capturing all the depreciation, all the amortization, everything that you can for your taxes, and that you're executing things the right way in that respect, and that you also have someone who's going to be able to in a timely basis complete your K-1s for your investors. So I don't do that, but a lot of the as an asset manager, you're still using that hat of your due diligence work. You're making sure that you're how are you performing towards against your plan. And so you're looking at the details, or I'm looking at the details of the financial statements, and if something looks off, going into the ledger and just seeing, okay, what are these expenses? It wasn't like this last month. What's different this month? Or even when things are good and you're like, wow, there's extra income, or this is higher income than we received before. Always asking why. Always asking why, because is it just a one-time blip where you just did better in collections, or, something happened, somebody paid that they owed before, but why is that? And so asking why really always keeps me on pace to understanding the property and understanding what's
Well, that's
happening
great.
behind the scenes.
So let me throw you a curveball now.
Okay.
Can you share with us an example when good underwriting and due diligence saved your deal?
Yes. So I would say that one of the things that we did, we had a deal where this is really more from the due diligence perspective. We had done our underwriting. We thought that the deal was actually going to be we were moving forward with this deal. But this is something I would say in the due diligence. We did not get the loss runs on the property. So from an insurance perspective,
Right.
until, and the loss runs are just, any incidents that have happened on the property. So we didn't get this until the very end of the due diligence period. And what we found is that there were a couple of incidents that were very significant for the property, that when we took that back to our insurance, the insurance that we had estimated was actually not at all in line with what the real cost was going to be.
Wow.
Because of those incidents that happened on the property. So for us, we had to make a decision. The insurance broker said, well, if you own the property for a year or so, you could probably petition having these higher fees, or, maybe there's a way to work that out. But we were syndicating deals, and we felt that was too high of a risk for our investors. And so, what due diligence helped us do, and unfortunately we got that right before our due diligence period ended, we actually had to pull away from that deal. We didn't move forward. So having that discovery prior to the due diligence period means that, number one, we saved our EMD, our escrow deposit, so we were able to get that back. Two, we did take a hit because we had already paid for legal fees and
lot of stuff,
all of this stuff that we had to do, but we had not executed yet the bank agreement, so we didn't pay for that. So, but at the end of the day, we knew that was the right thing to do on behalf of our investors. So while we did that underwriting, you have to get that information prior to ending your due diligence period, in addition to doing your inspections. So that you're not going to be overexposed and come out with quotes that are already high.
Well, that is such a great example, and that's the best thing to do, right? Back out of a deal. And a lot of time I have done once where I ended up executing the deal, even though I thought it doesn't seem right, because I didn't want to lose my EMD. But in the end, you end up paying far more, and you you take over a lot of headache, right? So I know that's great. And of course, things could happen, right? So that is one more question I have. Did you end up with a bad deal, even after doing all the solid underwriting and due diligence?
Right. So one of the things I'll say is it wasn't a bad deal, but we definitely had to pivot strategies. Okay. So your underwriting isn't a crystal ball. It's your best knowledge of what you think is going to be happening for that property. So it doesn't predict things like a global pandemic, which, no one saw coming. So for example, for one of our properties, our business plan was to execute a value add strategy. So we were going to go in and make some significant updates to the units, and then charge a significant incremental rent, but what we thought was in line with what that product would call for in the market. However, to do that in the beginning of 2020, just in the beginning of the pandemic. So as the pandemic unfolded, we thought that it didn't make sense for us, and there was uncertainty about collections. It didn't make sense for us to spend all of the money in our reserves to upgrade units that we didn't know if we were going to be able to get that rent for. So while that property ended up still doing well, it didn't do as well as we had projected because we couldn't implement the strategy that was going to provide the highest revenue. So what we had to do was, just really maniacally manage the turns, making sure we were doing something to continue to grow revenue, but not at the pace that we had planned on doing. And we had to pivot strategy for that one.
And do you still own that property?
We don't.
Okay.
We actually sold it, and it still did well for our investors, and especially given the fact that we had to change our strategy, we still got really good returns for that. So, it was a hard earned, ending for that one.
No, I do. So what are some of your favorite real estate markets right now?
So I've really started out looking in the Southeast. So that's been for, Atlanta. A lot of people are in the Southeast now. So
yeah,
so
that's where I invest mostly.
Yes. There's the more favorability for landlords. And again, we're running our properties. We want to provide high value for our properties, and so we just want to make sure that if people are not paying and they're not able to stay in our units, that we're able to find residents that do. So having that as part of the governance, if you will, of the cities is important for us. So Southeast has been favorable for us for that. So Georgia right now, we're currently in Alabama, and we're continuing to look at other states as well in the Southeast to invest.
No, that's great. Those are two of my favorite markets too. Birmingham, Alabama, and Atlanta, Georgia.
Yeah.
And of course, we invest all South Carolinas, North Carolinas, and we started also investing in Midwest, in Iowa market mostly. So, no, that's great. Good to get confirmation from people like you as well that Georgia and Birmingham or Alabama are some good markets.
Yeah.
What has been your best real estate investment so far?
I would say our best deal was our first deal in Atlanta, where we got, we came in at a really good basis, especially compared to where things are now. The timing of it was great. It was a time when you could really execute like an operational value add strategy, and not like a full heavy lift, physical value add strategy. We changed management. We were very in tune with, we found a property management company that was very in tune with the resident base, which was a very niche base. It was, a group like individuals who were refugees. So they're people who are legally here in this country, but they were fleeing for whatever reason from their respective country of origin. And but they were very reliable payers. It was really a great first deal. I'll tell you though that towards the end, when we were looking to sell it, we had there was a fire in the property, and our first, we were looking to sell, but we had stopped the sale, and we focused on making sure, thankfully nothing happened to the residents. All the residents were okay, and then doing some updates to get the apartments back. But in doing that, we actually got much higher rents than what we were charging.
Oh, wow.
So it ended up being better for everybody involved, and for our investors, because we did very well on the sale for that.
Oh, that's awesome.
Yeah.
Any challenges you have faced in this business other than, of course, the pandemic?
Yeah, I mean, so there are always, there's always depending on the asset class that you have. I mean, we typically invest in workforce housing and C plus properties, people who are renting because they have a need and they may not have the ability to buy a home, and we want to provide quality homes for them. Sometimes there are challenges though with collections. That's always something that's
Right.
important to manage and understand, and just having a really good communication plan, having a property management team that's hands-on, that really helps with that, because you need to have that constant communication with residents, especially if things aren't going the way you expect them to, just understanding that and working things out. And sometimes residents, they'll just leave, and that's okay. We can bring in new residents, or we're otherwise, we're working, we're trying to make the best of that situation. I would say also, older, if you're investing in properties that are a little older in age, you'll have to spend some money to do some capex work to keep them up and running. So those are some of the things that you have to manage. You have to manage the budget for that, especially if you have like a bridge loan, and
Yes.
monitoring that very tightly to make sure that you have the funds, and that you'll be able to do what you planned on doing for the property. So those are all things that come up throughout the whole. Then you're dealing with people and
People,
individual
yes.
lives, and
They all have, yeah.
it's,
We can't put ourselves in everyone's shoes, right?
yeah,
They all have
yeah,
their own issues.
right, exactly.
No, this is great. Thank you, Sonia. Let's take a quick break. And after the break, we'll go to the same questions I ask every guest.
You're listening to the Wealth Matters Podcast. The Wealth Matters Podcast. For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. Sonia, are you ready for fire round?
Yes.
Would you be changing any business or investment strategy because of inflation or recession?
Yeah, I would say, it's not so much of a change, but just being very particular with having reserves, having more cash on hand than we probably would have in the past. And sometimes that, that does affect returns. It makes the returns look lower, but it's always good to have the money up front. And if you don't need it, you can always return it to your investors.
Right. No, that's great strategy. Favorite real estate, finance, or business book?
Oh, so I would say the Landlord Entrepreneur by Brian Chavis. What I
I have
really
not
like
read
about
that
that,
one.
yeah, what I really like about that book is it really goes into detail, some of the things that you need to know, managing a property, an apartment complex, and it goes into such great detail. It gives a really good overview. So
I'll have to check it out. Any tool or website you recommend or you cannot live without? Maybe it's for due diligence, maybe underwriting, maybe investor management.
Yeah, I mean, so one of the things that we've migrated to right now is we used to manage this manually before, but having an investor portal, having
Yes.
an investor is so important and so much more efficient than how I've done things in the past. So that's one of the tools. And then I'm also using Monday.com as just a
Yep.
way to kind of
Project.
categorize and keep notes, track of everything. So those are the two that I really like using.
Any advice for beginner investors?
I would say, find groups, people that will support you, throughout your journey. I think sometimes it can be, if you're not, it can be deflating because you may be looking at deals or looking for things, and it's very competitive out there. So I would say, be part of groups, communities that know what you're going through and can help support you through that. And for me, it was that group that helped a lot. And then also just learning by investing, but also just taking action. That's the best way to learn.
That's awesome. How do you give back?
So I am a board member of an organization called the Council of Urban Real Estate, and that organization is in New York. It originally was founded many years ago as African American Real Estate Professionals of New York. But in 2014, when I became part of the board, we really stepped back and thought about the mission, and we really just expanded it to include, all minorities and women,
Right.
to just have more, representation in commercial real estate.
Now that makes sense. Thank you for doing that. How can my listeners reach out to you?
So definitely on LinkedIn, you can reach me on my website at bedrockreinvestors.com, or you can send me an email at sonya@bedrockreinvestors.com.
Thank you, Sonya, for your time.
Thank you.
Absolutely.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!